Good morning, everybody. It is June 28th. Welcome to our Tuesday weekly morning webinar, 10 a.m. Good to see everybody. Many of you are joining us perhaps for the first time. You're newly coming out of the most recent Changing World of Retirement class, or maybe you've got the last class tonight, but welcome to the new folks. This group of us grows every single month, and I appreciate that. So always good to provide that education and those updates. So let's swing right into it. You'll notice some things going on here. I don't know if it was on this webinar, but I promise you that picture, or that 2020 Wealth Manager, 5-star Wealth Manager Award, is not crooked on my wall. I had to replace my camera, and I can't quite get the adjustment right. So anyway, now I just made it worse. But the webcam kind of kaput on me that I've been using for the past couple of years. It kept flashing black screen, so that was no good. But good seeing you all. Big group for a summer day. Hopefully some of you are calling in or dialing in, whatever term we want to use, from a vacation spot. So let's get going here. I just want to remind everyone that you are, of course, recorded. You are on mute as well. There's a question and answer button at the bottom of your screen, and you ask questions as we go. Today, we're going to talk a bit about the markets today. We've got a good update from the Slott group. We did not have a webinar last week. That was one of the first times that we skipped the Tuesday webinar after a Monday holiday, and that worked well for me. I hope it was okay for you. It's really difficult for me to put the information together when I'm missing that first day and have it be timely for you, because the analyst reports aren't in, the market data isn't in. It just everybody's a little lagged. So today we're going to go over some Slott updates. Very good. There's just one update, but it's pretty long, so I just kept it one. The other ones were very technical updates, so I thought they really didn't apply. We're going to go over some market updates and just really one analyst report that I liked. The analysts are kind of stuck in the mud right now, and not a lot of great information that's different and interesting. Everyone's really kind of just concerned about what the Fed's doing and inflation and interest rates, and there's a lot of reasons to be concerned right now. I'm always optimistic, but I'm certainly concerned from an investment point of view. There are significant changes we've made in our portfolio holdings, and will continue to make. I was on a call yesterday with a firm that I respect, a RIA firm like we are out on the West Coast, and a couple others. There was a conference call, and we were talking about market strategy and kind of the best place to place funds and different things that we're doing. It's a group that it's kind of a focus group, so that's very helpful to get different perspectives. Of course, I said perspectives because I'm a financial planner. So we're going to talk about Slott updates. We're going to have some market updates, and then we're going to talk about our financial planning topic, which today is taxation of Roth conversions. And I'm certain, I'm not going to look, but I'm certain she's on this call, but I want to thank Kathy for this. So I've been using the same set of notes for several years for my case study for the class. And Kathy let me know, or some questions she had, and maybe some items that might want to be addressed. And it was a good exercise for me, because I hadn't looked at that other than just looking at it and using it as a template. But I had to go back to the original documents to remind myself where the numbers came from. So I thought it would be good to share that with you. So we'll go through it. We are wrapping up tonight the final Changing World Retirement Planning class that we're going to have until the fall. We've been at quite a run. We've had something every month so far this year. So January, February, March, April, May, now June. So we've really been hitting it hard, from having David McKnight here, having special events, having I think this is our fourth class for the year so far. So we're going to take a little break over the summer and see if we're going to continue, how we're going to continue in the fall. Hopefully we'll do some live classes, but we'll see how that goes. These webinars have been very successful in convenience, and certainly from a number of people signing on to the webinars. We're at a really great place in our practice where we've had to ask people to delay coming on as clients. We have a bit of a wait list, so I feel bad about that, but at the same time, we have to make sure that we're taking care of our existing clients and not piling up just new clients. So we typically don't take more than 2 clients a month, and we are on a bit of a wait list at this point. I couldn't tell you exactly where we are. I'm sure it's August, if not September at this point. So let's get into the, I'm looking at headlines. You know, inflation is still top of mind for everybody, still over 8%. But let's talk about the Slott update. Now, this comes in, I'm going to share my screen in a moment. I'm just preparing it here. This comes in last week, so Wednesday, June 22nd. So this was, well, it would have been right after my webinar last week. But it was, this discusses, just raise your hand for me. My picture's frozen there. Uh-oh. Raise your hand for me if you can see my screen, see me and hear me still okay. Please. Thanks. Okay. Thank you, everyone. So let me get myself out of the way here. All right. So in this Slott updates, Ian Berger talks about Senate committees take up retirement savings proposal. Now, this happened last week. So the Finance Committee of the Senate talked about the potential changes in retirement legislation. And I won't repeat it. I'll just let us go through it here. And it is rather long, but I'm sharing it. And we'll go through each item. I hear questions about this a lot. That's why I thought it'd be good to share. So Ian writes, proposals to boost IRA and workplace plan savings are advancing, but they are not law yet. He put this in bold because we get these questions over and over again. I hear that required minimum distributions are now age 75. No, that's not true. They're still age 72. There is legislation to change that. It's really far off, in my opinion. Even if they enacted this legislation today, it delays the increase in age too long. But these suggestions, and that's what they are not law yet. So to give you some background, on March 29th, the House passed the Securing a Strong Retirement Act of 2022. So we're calling this Secure 2.0. Now, 2 different Senate committees are taking up the subject. There is a pretty good Barron's article about this. I think it was Barron's that I was reading with some updates after this, just not as thorough. They didn't do as thorough of a job as Ian does here. So I'm sharing this one. On June 14th, the Senate Committee, Health, Education, Labor, and Pensions unanimously approved the Retirement Improvement and Savings Enhancement to Supplemental Health Investment for the Nest Egg, the Rise and Shine Act. We've got some creative people down there in Washington. The Rise and Shine Act deals with company plans only. Today, this was last Wednesday, June 22nd, a separate Senate committee, the Senate Finance Committee, is taking up its own bill called the Enhancing American Retirement Now Act, or EARN Act. The EARN Act deals with both IRAs and company plans. So the previous discussion was just about company plans, and this one in the Senate, coming out of the Senate Finance Committee, talks about retirement plans and IRAs, individual retirement accounts. So one thing I always want you to remember, and I repeat this often, the rules for retirement plans and the rules for IRAs are very different. They act the same way. The accounts act the same way from a tax deferral point of view. And that's really it, unless I'm missing something. But, you know, and the rules around when you can draw them to some degree. But so let me back up and say they have some similar rules, but they are vastly different. So don't confuse the two. People have a hard time when it comes to required minimum distribution time with having retirement plans, 401ks, 403bs, et cetera, and individual retirement accounts. And sometimes they get penalized for not taking their withdrawals because of that. The Senate Finance Committee is expected to pass the EARN Act. If that happens, the EARN Act and the Rise and Shine Act will likely be combined into one Senate bill. The combined bill will then be taken up by the full Senate. If passed by the full Senate, the Senate bill will have to be reconciled with the House bill and approved by both houses of Congress before being sent to the president. So you can see there's still a lot to do with these bills, but this is good discussion. And this is, our process. These bills are often referred to as Secure Act 2.0. I discussed that because they expand on the original Secure Act from December 2019. Here's how the House passed bill and the Senate earned bill compare on on several key changes. Both bills would increase the age that traditional IRA required minimum distributions must start. Currently, the first RMD year is age 72. The House bill would delay the first RMD year to age 73, the beginning of 2023, 74 in 2030, and 75 in 2033. You see that we've got this kind of gradient scale, and it takes a while to get to age 75. The Senate earned bill would change the first RMD year to age 75 without interim changes to ages 73 and 74. However, the change to age 75 would not be effective until 2032. Moving on, both bills would allow higher catch-up contributions to company plans. Let's hope that goes through. The current catch-up limit for those age 50 or older is $6,500. Both bills would increase that limit to $10,000 beginning in 2024. Another area of confusion with some folks. The House bill would apply that limit only to those who are age 62, 63, or 64, but the Senate bill would apply it to those who are 60, 61, 62, or 63. For IRAs, the current catch-up limit, now let me just pause there for a moment. I think you're starting to see that with every layer of legislation coming out of Washington, it actually makes IRAs and retirement plan planning much more difficult, doesn't it? There is really no simplification here. That would be wonderful. But what's happening is they're layering in these ages and these timelines and these triggers, and it's going to make it harder, more challenging for us. More education. This is another area where it makes sense to be involved in a group like the Ed Slott Master Lead Advisor Group, because could you imagine trying to navigate these changes all by yourself, or at and I got to tell you, folks, the large firms don't have the resources to educate their advisors on this information. So for IRAs, the current catch-up limit is frozen at $1,000. Both bills would allow that limit to increase based on the cost of living. The House bill would be effective in 2024. The Senate bill would be effective in the year following the year the bill is signed into law. Both bills require that any plan catch-up contributions for those over age 50 would have to be made as Roth contributions beginning in 2023. This is an important point. The Congress is always, well, in the last several times that they've discussed changes in the tax law, they've been trying to push into Roth accounts because they want that tax revenue now. This is one reason that I'm very confident and comfortable with the idea that Roths are here to stay, because if anything, Congress is trying to do away with that or limit that tax deferral option because they want their money now. Let's see. Roth currently employer contributions are made pre-tax. And that having employer contributions also go into the Roth contributions is fabulous. The House bill is effective after the date the bill was signed into law, while the Senate bill is effective in 2024. These changes are designed to help pay for other provisions of the bills. In both bills, the limit on charitable qualified charitable distributions, QCDs, they become very, very popular. You've heard me talk about those a lot, which are tax-free direct transfer from traditional IRAs to charities, would be indexed for inflation. That limit is currently $100,000 per person per year. You have to be over age 70 and a half for that to work for you. This provision would be effective in the year the bill is signed into law under the House bill, or the year after the bill is signed into law under the Senate bill. Employers would be allowed to make matching contributions to company savings plans and simple IRAs on student loan payments beginning in 2023 under the House bill, or 2024 under the Senate bill. Both bills, in both bills, the Savers Credit, a federal tax credit for mid and low income taxpayers who contribute to an IRA or company plan, would be expanded, but not until 2027. Both bills create a new exception to the 10% early distribution penalty for IRA and plan withdrawals by victims of domestic abuse. This would be effective immediately after the provision becomes law. The Senate bill, but not the House bill, would create another exception to the 10% penalty for emergency withdrawals beginning in 2024. We'll keep you informed on the progress of these proposals. So I hope that's helpful. I think that is a great update from Ian, and I appreciate all the work he put into that. So I'm going to stop my share there and going to continue my notes. So let's talk about the markets. So last week was actually a very good week in the markets. So this ending June 24th. Let me just double check. I think that's right. Ending June 24th. Yes. So the Dow Jones Industrial Average was up 5.39%. The S&P 500 was up 6.46%. The NASDAQ was up 7.51%. All the indices across really all of them except gold. Gold was down and commodities were down about 4.5%. But all of them were down, or excuse me, up for the week. Year-to-date numbers are still not great. So the Dow Jones Industrial Average is down about 12.5%. It's a little worse after yesterday's day, but it looks like markets are up slightly today. Last glance I have there. The S&P 500 is still down 17%. NASDAQ is over 25%, and it continues on. And what's most frustrating for many and most investors that are just following simple investment models, the 60-40, the age-based portfolios, the bond allocations are down anywhere from 11 to 15%. So as high as 18, goodness gracious, as high as negative 18% for bond allocation. So the lowest here, negative number I'm seeing for the Barclays aggregate 1 to 3 year index, that's the most shorter duration bond. So we should have the least amount of volatility is down 3.29%. And probably the most typical investment range for investors we track with the Barclays aggregate bond index 7 to 9 years, let's just say, and that's down about 11%. So folks are seeing their Dow Jones Industrial Average down 12.5% and their bonds down 11%, and they're saying, wait a minute, this isn't how it's supposed to work. So that's why you've got to be you got to think of your investments much differently. Not last week, but the week prior, I did the video on the 3 pillars of investment management. That was the discussion in our weekly webinar. I shipped that out to everybody. I am working on a process to send these recordings out shortly after the weekly webinar, just so you have it in your inbox in case you missed it, or in case you want to listen to it again, send it to a friend, whichever. But we are working on that process. So only one analyst report that really caught my eye and I thought was worth talking about, and that comes from Riverfront. Again, I don't invest with Riverfront Investments. I appreciate their analysis, and I refer to them also often. I have a conference scheduled with them tomorrow as well that they're putting on about market updates. So they talked about the stock markets have entered a bear market over the last 3 months as the Federal Reserve has raised Fed funds rate to slow the pace of inflation. In our view, in their view, that's why federal funds rate is Fed funds is raised. The Fed funds rate is to slow inflation. Pretty obvious. In this, let's see. They talk about the signals they see as it relates to their 3 tactical rules: don't fight the Fed and don't fight the trend, and beware of the crowded extremes. Currently, they believe their 3 rules are sending a defensive signal as both the Fed and the trend have turned against investors. The key takeaways include global central bankers are no longer investors' friends in our view, right? So they're saying these aggressive rate increases are going to continue to hurt the markets and potentially the economy. We believe the trend will remain a headwind for the foreseeable future, and our 3 tactical rules in aggregate are flashing caution. Makes sense. I'm not seeing many folks and many analysts out there that are very optimistic. If you find some, you can send it my way. They're one of the few analysts that are still talking about the war in Ukraine. That's very good, because the headlines are just absent that situation that's going on over there. So remember, we want to stay defensively optimistic. This can turn at any time. However, I think we're probably in a tough position for the next year and a half to 3 years. So we definitely have to think defensively, and we've got to make this, decisions and adjustments to shore up our foundation. But you're seeing, of course, you just can't sit in cash. We're still sitting in a lot of cash, but you can't do that in the long run because we have to overcome just normal inflation. Forget about trying to overcome 8%, or let's hope it drops to 6%. Everybody would be celebrating if it's at 6%, but that is still not something we could sustain over the long term. All right, let me just check to see if there's any questions before I move on. No questions. Okay, I'm going to move on to our financial planning discussion. And I'm going to share my whiteboard here. All right, you should see my whiteboard. Just raise your hand, hit the raise hand button if you see my whiteboard, financial planning topic, taxation of Roth conversions. So let's first talk about what is a Roth conversion. So we're going to go back to the real basics here. You guys all know this, but I'm going to drop down for a second and just explain the absolute basics when we're talking about different types of accounts. So you all remember your buckets. You've got your taxable bucket, your tax deferred bucket, and your tax advantaged or tax free bucket. So your taxable bucket is anything that generates 1099s other than, 1099Rs come out of here, right, for retirement. But anything that generates 1099s and you pay tax every single year, whether it's CDs, I should put these here, CDs, mutual funds, stocks, bonds, etc. Whatever you're getting tax on every single year. There's 1099s you get there. There's K1s. There are, pushes tax out. You often can't control that. Many times you can't. You pay tax on long-term capital gains. Sometimes mutual funds, they push out these gains and you have no control over it. That happened on a grand scale with a Vanguard fund. It was a Vanguard fund last year. You pay short-term capital gains. You pay tax on dividends. You pay tax on interest every single year. Whatever you hold in here, you pay tax on. And we identify a mathematically ideal amount that you should have in each one of these buckets. And we like to say that in this bucket, you should have 6 months, ideally, to 1 year of your living expenses. If you have too much in there, then you're at a higher risk of not being able to control this tax. And right now, you might say, well, long-term capital gains are taxed at 15%. For many of us, that's higher, 18.3% because of the surcharge. But very soon, that's likely to increase as well. And then we know 6 months to 1 year of expenses is what you want in this bucket. And then you have the tax deferred bucket. And this is where you have your traditional IRAs, traditional 401ks, and other retirement plans. And anything that you've promised to pay later, right? So you've got a promise to pay at a later date. And the big issue is, what is the tax rate going to be? And it's going to be the I don't know tax rate. So I'm very happy with the way this whiteboard's working today. Maybe Bill Gates has heard all of my complaints about the update. So I want to thank whoever reached out to Bill to let him know. But with this tax deferred bucket, again, anything you promise to pay later. And of course, the issue is that when you promise something that you're going to pay later, you don't know what the cost is going to be in this case. And Congress, through their difficult process and many layered process that we just reviewed on a very, very small scale, they can change this at any time with really without any warning. They can make, usually their changes happen very slowly, as you witnessed with the Secure Act 2.0. Sometimes it happens very quickly, like we saw with the CARES Act in 2020. And I think that when we start seeing significant tax increases come 2030 or before that, there's a little bit of a range before or after that, we're going to see very, very fast legislation happen because we're going to be in crisis mode like we were during the pandemic. So with this bucket, we haven't paid tax on that money yet, or we've gotten a tax deduction for the money we put in. So we have to pay tax when we distribute those funds, and the IRS governs when those funds should be distributed. We talk about that. We just reviewed required minimum distributions now currently start at age 72 and after, and the IRS tells you exactly how much you have to take out, whether you want it or not. So here's the amount you have to take out, and then you got to times it by your I don't know tax rate, and then you're going to pay tax on that. And if you believe the tax rate is going to be higher in the future, which I'm sure all of you do, then one of the things that you want to do is start moving money from this bucket over to this tax advantage bucket, if you haven't done so already. So the question, of course, is always how and what's the best way to move money over here. There are only two things that are truly tax-free. We talk about that in our classes. Anything Roth IRA, 401k, and properly structured cash value of life insurance, sometimes referred to as a life insurance retirement plan. So there are really the two things that are truly tax-free in our definition. So we understand that we want 6 months to 1 year in the taxable bucket over here. In this bucket, if you don't have pension income or rental income or other regular income that you can't control, then you want an amount in here that is that creates an RMD that is less than your standard deduction. So that's the goal for this bucket. For some people, that can range from $500,000. Some people it's $0. So it all depends on your situation. And then everything else, we want to get over this tax advantage bucket. Okay, so they're the basics. I see a question. I'll come back to you for a second. So then how do we get money to this tax advantage bucket? So this first is contributions. We can contribute if we meet the requirements, and you can certainly visit the requirements in one of my videos, or go onto our website, outofourwealth.com, and go to the Slott corner and look at the charts that tell us when you can contribute to a Roth IRA or Roth 401k. So if you can contribute, you can contribute. The second way to do it is a conversion, and that's what we're talking about today. So a conversion allows you, the IRS says we can take as much or as little as we like from this tax deferred bucket and transfer it over to this tax-free bucket. So you have dollars here and you transfer dollars here, and we can do $1 or we can do $1 million in any given year. The formula that comes up to you is how much tax are you willing to pay? Because when you cross this bridge, the toll is tax. So the best way mathematically to pay that tax, of course, is, let's just say, for example, your conversion that you want to do this year is $100,000. So you want to take $100,000 this year from your IRA and add it to create a Roth IRA. If you don't already have one, if you already have one, add it to your Roth IRA. Well, if you're in the 20% effective tax rate, back up here, just to make the math easy, you're going to owe $20,000 on that conversion. And yes, it goes on top of all the other income that you have. And I'm not going to get into that calculation right now. I'm going to show you a little bit in a minute. But the best way, of course, is to pay that $20,000 out of this bucket if you have it, or if you're comfortable writing the check for it, because mathematically, this makes the most sense. You pay your tax out of this $20,000. The full $100,000 now resides here. Any growth that you have, as long as you meet the 5-year rule requirements, now comes out of here, 0% tax. So if this $100,000 grows to $1 million, for example, let's say you just have great growth over the next 20 years, that $900,000 that you have in growth, you haven't paid any tax on. Well, that's great. That's a great win for you. It completely erases that tax rate risk in the future. So for most people, it makes sense to pay that out of here, but there are some people who can't or won't do that. Sometimes folks have the large majority of their money in this tax deferred bucket. and they have a smaller amount in this taxable bucket. So it doesn't make sense. They, from an affordability point of view, they can't pay the tax out of there. Some people have plenty of money in this taxable bucket and they say, I just can't write the check. I can't write the check for that $20,000 or $40,000 if you're converting, twice that amount, $200,000. Sorry about the noise there, folks. Let me turn off my speaker because I don't want that to happen again. So some people just can't write that check, and rather than stalling or stopping a conversion process that makes sense just because psychologically you can't write that check, or if you can't write that check financially, if it doesn't make sense to take it out of the taxable bucket here, then what we do sometimes is we use a system called withholding. So what that means is when we're helping our clients do these conversions, the $100,000 is converted and we take the tax out of that conversion through our custodian and we send it right to, now that $20,000 is sent right to the IRS, not unlike your paycheck, the withholding in your paycheck. If you make $10,000 a month, $2,000 a month, or whatever your tax withholding percentage is sent to the IRS, you get $8,000 net payment in your bank account. And that is, that's your tax withholding that is automatically set to the IRS. And then you reconcile it. You're filing your taxes is really the reconciliation of how much you owe and how much you paid in. So you reconcile it at the end of the tax year. You either get a refund, a credit, or you owe, right? So it's the same idea. And then what, in that case, if you withhold, then it's not the $100,000 that's over here, it's $80,000 that's over there. So now withholding is, and that's okay. If psychologically it makes sense, of course, the math is going to be better. As I said, if you can pay the $20,000 over here, but better if it makes sense for you to do Roth conversions and have a tax efficient strategy, better to convert via withholding than not convert at all. So I hope that makes sense. Now, here comes the question that Kathy had. So why so much tax? So we did 100, in the example I had, we did in the class, we had $120,000 of conversions, and I think we had about $36,000 in tax. So I went back and I had a look at that. So first of all, this class was geared to folks, mostly, there are folks from all over the country, as there typically are, but mostly geared to folks in New Jersey, and New Jersey has tax on some IRA distributions, including Roth conversions, because a Roth conversion first is an IRA distribution. You're allowed to do this distribution beyond some of the other requirements that don't allow you to do distributions. So it is an allowable distribution and switch or conversion to the Roth IRA. So one of the things that that caused that different amount in tax is, so we talked about where to pay tax from, right? Whether it should be ideally the taxable bucket, but better than doing no Roth conversions, if they make sense for you, it's okay to do withholding. So we can say here from taxable or withholding. And I hope everybody understands what withholding is. And if you're doing withholding, so let's if we're doing withholding, then we have to gross up that contribution. So I'm going to share with you a spreadsheet we use internally that, no, I can't send this to you. This is just something we use internally. And I did, I showed you what this gross up means. Gross up is simply, if we do $120,000 in conversion, and I know I just used 100,000 on the chart, so I can change this, but let me get my keyboard back. We're going to be going back and forth on this a little bit, but we've got some states, and New Jersey is one of them, up to certain areas. And actually, let me share this with you first. No, I'm going to talk about gross up first. Let's go to Pennsylvania. Pennsylvania has no state tax currently on IRA distributions. It's a pension-friendly state, so no tax on pensions or qualified IRA distributions. Pensions or then Pennsylvania is easy. We got $120,000 conversion amount. And if we want to stay with the example on the board, we can do $100,000. That's fine. If we have an effective tax rate of 20%, well, the total tax amount on the conversion is $20,000. The total distribution, though, would have to be $25,000 to cover the extra amount that has to be done for the distribution of the withholding. I hope that makes sense. If we're also taking the amount out of the IRA, then we either have to reduce the amount that is converted over, or we have to gross up the IRA amount. So the total amount for distribution of 100% withholding would have to be $25,000. And this happens even if we end up with $80,000 in the IRA, because if we're taking an additional $20,000 out for distribution, that's an additional amount that has to be taxed in the IRA. I hope that makes sense. So the total taxable amount of the conversion then is $125,000. The federal tax is $25,000, and there is no state tax. Now, New Jersey, for example, has a state tax rate, and it's there's a really good guide here that I'm going to share with you. I'll pull this down, and I'm going to put these links not for the spreadsheet, but for the websites I'm going to share with you. So there's a state-by-state guide that I found in Kiplinger's, and I have to tell you, this was not an easy find, but thankfully, this isn't too old. This is from December 2021. There's just not a lot of great information out there. But if we go to example New Jersey, this should get us there. So you'll read here how New Jersey taxes IRA distributions, including Roth conversions. So it's very confusing for taxpayers with gross incomes of $100,000 or less. The maximum exclusion is $100,000 for joint filers, which means there's no tax, $75,000 for single filers, and $50,000 for married taxpayers filing a separate return. For taxpayers with gross income between $100,000 or $101,001 and $125,000, the maximum exclusion is 50%. So that means that 50% of the amount over that 100,000 would be subject to tax. And then it reduces, of course, for single filers. And yes, of course, this is confusing. So you can, I'll put this link in here, and you can take a look at whatever state you'd like if you want to click through. And there are 12 states that don't have any tax currently on IRA distributions and pensions, and Pennsylvania is one of them. So you can go into Pennsylvania and you'll see our state tax rate is 3.07. There are no taxation. There is no taxation from a state tax point of view on Social Security benefits, and no taxation, as I said, on qualified distributions from IRAs and 401ks and retirement plans and pensions. So you can look at all those. I'll include those. And this is a really good tool if you're going to try to decide where to retire, because some people love the state of Delaware, for example, because there's no income tax, there's no tax on retirement distributions, there's no state sales tax, so they like Delaware. And then once you figure out how much your state is going to tax, if anything, of your retirement, then you have to look at the state tax rates. I'm trying to drag this in. So this comes from this website I found, taxfoundation.org. These are all, I don't verify. Some of them were just completely wrong, by the way. Some of the information I found on the internet was just completely wrong. This seemed to be correct. These two lists I'm sharing with you seem to be correct, but go to New Jersey again, and you can see that it gets a little more complicated with New Jersey, because then you have this scale. So anything greater than 75,000, you're at 6.37%. It starts at 1.4 and goes all the way down to 10.75. California is the worst, I think. California or Hawaii, can't remember which, but California is 13.3%. Now that's over $1 million, but if you're in, you're still at 9.3% if you're over 61,000. So this is a good table. I'm going to put, these are single filers. This is married filing jointly over here. I'm going to put a link here to in my YouTube video where you can grab this. So using this calculator for New Jersey, I put in the 6.37%, but that shows that the federal tax, if we're withholding as we were in the example in the class, takes the federal tax because you have to gross up. So you have to take more out, and then you got to pay tax on that more. That's why it makes it mathematically better to take it out of the taxable bucket instead of the tax deferred bucket. But if you're, again, if it's between not doing a Roth conversion, if it makes sense for you, and doing a Roth conversion, it can still make sense to withhold. You just got to know all the nuances. Then here on New Jersey, the state tax is an additional $10,000. So on that, or in that example, the total tax on that conversion of $120,000 is $42,000. That's a big bill, or $43,000. So the example we use is actually a little less for the class. So I appreciate that, but I think what I'm going to do for the class example is just make it simple. I tried to include capital gains because I went back and looked at the original notes, because it was an actual plan. We looked at capital gains tax, we looked at the gross up tax, but I'm going to keep it simple just for illustrative purposes. But there are 12 states that won't tax your currently, that won't tax your retirement. And let me go back here to this calculator. So what if we had a client who currently lived in New Jersey, and they said what many people who live in New Jersey say to me, and one of the things that they say is, as soon as I retire, I'm going to move out of this state. So it may make sense for them to wait, wouldn't it, to do Roth conversions. So that's one of the things we would look at in the plan is, what if we waited, 1 year, 2 years, whatever it was for them, what's the long-term net effect? Sometimes it makes sense just to move forward. If I'm going to stay here, I have no plans to move, or I'm going to be working another 5 years, and who knows what the tax code is going to be at that time. It may make sense to do it now, but this is a decision point, because if you said to me, I'm moving to Delaware in 6 months, I would probably say, consider not doing a Roth conversion this year, and wait till you establish residency in Delaware. I may not, but I may, make that recommendation. All depends on your situation. But you can see how that layers. First of all, the withholding layers over an additional cost, because you have to take more than the amount of just the conversion to cover that tax. So there are 12 states that won't tax your retirement. I landed here on Pennsylvania. While this is a great article from Kiplinger's, again, you've got to go through all these scrolls and ads. So I'll just share with you that currently, per Kiplinger's, it's Alaska, Florida, Illinois, Mississippi, Nevada, New Hampshire, Pennsylvania, San Diego, South Dakota, Tennessee, Texas, Washington, and Wyoming. So again, this list will be on there, but I don't expect that Pennsylvania will stay tax-free for another 10, maybe for another 10 years. Legislators I talk to say it has to change at some time, because just like the federal government, Pennsylvania has a lot of financial struggles. That they have to pay for pensions. They have the most expensive legislative branch. So, it's unlikely they're going to cut their own jobs. So it's very likely that you're going to probably start seeing, at least within the next decade, that retirement maybe is taxed like New Jersey on a sliding scale. But what we don't have is in Pennsylvania is, we've got 3.07% income tax. That's it, flat tax. I think they'd be challenged here in Pennsylvania to create a scale for retirees and just a flat tax for non-retirees. So that's what I expect to happen within the next 10 years. So be careful where you choose to reside, and pay attention to what's going on politically there and discussions. So I hope that makes sense. Okay, let's see. I'm going to stop my share for a moment. Okay, so it looks like we covered everything. It's spot on 10:45. So we talked about what is a Roth conversion. We talked about the buckets. I'm trying to move my screen back, but that's okay. There I am. I'm going to answer that question in a second that I see out there. Let me just move this aside. We talked about what a Roth conversion is. We reviewed your buckets, where to pay that tax from, whether you pay from the taxable bucket or the tax deferred bucket. Tax deferred via withholding, it's going to cost you more because you've got to take the additional amount for tax. It's that also has to be taxed. So if you have to take $25,000 out to pay tax, pay a $20,000 tax, you've got kind of that snowball effect. So you've got to do the math. There's no kind of rule of thumb that you can use here. You got to pay attention to both federal tax and state tax with Roth conversions, and you've got, just like anything else, you got to make sure it makes sense. All right, everybody, have a great Tuesday. Have a great rest of your week, and we'll see you next week. Take care.